world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Erin Collard is co-founder of Blend, a digital mortgage origination platform. Blend sits atop incumbent systems and digitizes the mortgage process, massively reducing costs for lenders and expediting origination. Blend's software is compelling. So compelling, in fact, that 25% of the US market now uses Blend's technology to originate $1 billion in mortgages every day. Blend has raised $160 million from leading investors, including Greylock and Founders Fund. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Erin Collard. Erin Collard, welcome to Rebank.
Thank you for having me.
You are the co-founder of Blend. Tell us a bit about Blend.
So Blend is a white label SaaS product. We sell to, all the banks and lenders in the United States, and in aggregate, our customers represent about 25% of the mortgage market. So it's pretty sizable. And so if you can imagine, we provide, a digital solution for every borrower that comes through your bank to apply for that digital mortgage. Collect all the data and documents in a digital way. And get a digital mortgage, saving time and money for the banks and the consumer.
Yeah. So it sounded pretty impressive. Something like $1 billion worth of mortgages is originated every day.
That's about right. Yeah. That's
by
right.
your platform.
That's correct.
Wow.
Yeah.
That's insane.
It did take a while. It was not overnight. It's kind of like
not that long, right? We just started in 2012, 13.
That's correct. 2012, May of 2012. Yeah. But I feel like it has been a long time.
Maybe in startup years.
Yeah.
So, quick backstory, because I think you guys are a really interesting one. You personally, and then you're kind of the founding team.
Yeah. So, I started off in the world. I kind of dropped out of a PhD and met this guy, Peter Thiel, and who was working at PayPal, and started that with Max and a few others. And he wanted to start a macro fund, Clarion Capital, which I was convinced to join. So I worked with him for about 10 years, and that's kind of how I met the other two co-founders who were at Palantir Technologies, which, if you don't know them, they're a very large tech company in the Valley, probably one of the most valuable private companies today. Yeah, and so they were instrumental in sort of taking a lot of the technology that Palantir did, which is sort of focused more towards the government sector, and applying it more towards the commercial sector. So the large banks and so on. And so I met them. I was working at the hedge fund, kind of watching the financial crisis unfold with Lehman Brothers, and the mortgage-backed security market sort of implode. And Nima and Eugene, the other two founders, were at Palantir watching, the large banks trying to figure out their portfolios. And I think a large takeaway that we sort of had was, Silicon Valley is not focused on helping, the housing market at all. No one was really focused on this at all. And it was kind of shocking the amount of investment in technology that a lot of the big players had done, shockingly little. And as a result, you sort of years after the financial crisis, I think we're still feeling some of the shockwaves of that.
So, if I kind of simplify in my mind, the problems that you're solving are kind of two, and one is around data quality and architecture and hygiene, and the other is around kind of digital mortgage origination. Is that right?
Yeah, no, I think that's fair. So, one of the idea was essentially we wanted to form the digital layer between the consumer sort of finding their home and actually getting their mortgage and ending up with in their home at the end of the day. And so what we're trying to do is, instead of the mortgage how it was done in previous years, you walk into your bank and you fax in your paperwork and you send in your pay stubs and it's email your social security number in an unsecured way. Whereas what we wanted to do was have a completely digital experience for every borrower to just apply online, connect your data directly. And so what you end up with is kind of a borrower to bond. So you end up with a completely digital mortgage, such that the bank can kind of turn around and offer it to Fannie or Freddie in the United States, which is the basic model, as part of their day one certainty for Fannie Mae. And so if you can imagine, if you have a digital machine-readable loan application, it's immensely valuable. So that's what we wanted to replace, which I think is when you start to actually have a lot of the loan applications going through, not just for mortgage, but whether it's HELOC or account openings, and it's all digital, it allows, and you start to change the works, the pipes behind the scenes. So the banks can have a greater transparency to the loans they have on their balance sheets, and so can Fannie and Freddie.
So maybe for the benefit of the non-U.S. listeners, just kind of the model with Fannie Mae and Freddie Mac.
Yeah. So I mean, as part of the American dream, they wanted to make housing accessible for almost everyone, and so the idea was, banks shouldn't have to sort of penalize people because of various reasons. The whole idea was to actually free up the banking system to provide homes to everyone. So
banks lend to homeowners and then sell the loans.
Exactly,
to Fannie
correct. So in the UK or in Europe, the banks actually keep the mortgage on their balance sheet, whereas in the US they turn around, and if it is sort of compliant with Fannie and Freddie's guidelines, then they sell it to them.
And then Fannie Mae and Freddie Mac securitize those, and we end up with interesting kind of diversified
That's correct.
cash flows.
That's correct.
Stuff that went bad previously but that shouldn't, and you guys' platform potentially provides a bit more data visibility into that whole
That's correct.
system.
So to put it in perspective, the U.S. housing market is worth about $10 trillion, and the U.K. is probably worth about $2 trillion. And a large part of that comes down to the fact the way the business is set up, such that we can provide housing with the GSEs. It's kind of unique, which is the size. So if you can imagine, all these loan products have much granular level data that you can actually search through. You can get more risk insights right across these loan products. So I think 2008 really changed the game, and I think a lot of things helps this company exist, because I don't think it would have existed prior to 2008. You kind of had this situation where you had increased regulation following the crisis, a lot more, the creation of CFPB, the passing of Dodd-Frank. And also at the same time, you got to remember a lot of the bank's margins, the profit margins were getting hit, and they still are. I mean, so put in perspective, in 2006, it cost a bank about $2,000 to $3,000 to originate a loan, a mortgage specifically, and today it's about $8,000. And a large part of that is this customer acquisition, but it's also increased regulation, compliance, and so on. And so what happens is, and it's not just the banks, it's everyone. When an industry goes through those kind of big regulation and big squeezes on profit margins, the first thing they do is throw bodies at the problem. Like they hire a whole bunch of people, and then you hit a point where your margin's so small. Essentially, you need to turn to better technology to start solving it. You've reached the limit. Yeah. And so I think that actually is a turning point, not just for Blend, but for the industry as a whole. 6 years ago, I was just commented earlier, fintech it was pretty nascent. I mean, it wasn't really a big driving force. And today it's everywhere. It's a lot of money being piled into fintech, which is great, because the consumer is the one that benefits the most.
Yeah. Well, I think the potentially the most interesting piece of your story presently is looking back, and we were kind of joking before about how 2012 to early 19 is kind of a long time in startup years, but it's not a long time to penetrate 25% of the U.S. mortgage market. And I think it would be extremely interesting to understand, for listeners to understand the kind of what the process was, right? Because not that it's easy, but building the technology is within your control. Getting banks to pay you to use it is not within your control. And that's often the hard part, and the stuff that fintechs aren't necessarily always structured well to deliver on. So like, how did you go from there's a better way to do this to dozens of banks are paying you for years to kind of run this part of the business for them?
Yeah, it's a good question. I think there's a little bit of luck and a lot of hard work. I think, when we started the company, the old way of doing things was still very paper heavy. And when we started to pitch some of the early lenders about this idea of this concept of a digital mortgage, and people will be getting mortgages on their mobile phone, they kind of left us out the room. And it wasn't until, I would say Quicken Mortgage came out with their Rocket Mortgage application, which is a large lender and very, very similar sort of digital concept. And it wasn't up until that point that it was the digital moment that everyone realized was going to happen in mortgages, and it was going to happen in the financial services more generally. So it wasn't until that moment. And then what happened was every large bank suddenly realized that they're going to be behind, and that this digital moment is actually really happening, and we need to get in front of this. And so I think for the smaller players, I think it sort of levels the playing field, where if you use a company like Blend to provide to your borrowers the digital experience, you can kind of do it without having to build it. And for the large banks, it's a very fast and effective way to kind of get up to speed. Yeah. But there's no easy silver bullet to kind of convince the Wells Fargos of the world.
Yeah, who are one of your clients, right?
They are. So Wells Fargo and U.S. Bank are some of the biggest banks in the U.S., and they're our clients, and they're certainly in the top 5. And then we have sort of non-bank lenders like Movement Mortgage and so on, who all use our product.
Wait, when did Rocket Mortgage hit the market?
It was about 3 years ago or so.
Okay. So what did you kind of notice a difference in terms of banks' willingness to adopt pre and post?
Yes. No, absolutely. I think it was kind of one factor in many.
Mm-hmm.
Up until that point, like, there were a lot of naysayers. Like, it's people love to go walk into brick and mortar and shuffle through vast amounts of paperwork to get a but it's like a 2,000-page document, and they're like, it'll never change. But I think once you see the writing on the wall, here's the other thing. Consumers today. I mean, I don't know if you have children, but when you do, or if you do, I can't imagine my children walking into a Bank of America or so on, or any other the large banks, and saying, "Hey, listen, can I get a mortgage?" and filling in reams of paperwork. That's just not going to happen. So there's this more Uber type experience where they actually just expect a digital experience, and they get very frustrated if they don't have it. And in financial services, consumer experience is just a byword for lifetime value of the customer. So if you can get someone to get a mortgage with your bank because you provide a really great experience, they're likely to open their an account with you. They're likely to get a student loan for their kids. They're likely to do a whole host of different things. And so that's the true value of getting a customer for their life.
I want to dig in here on this point about closing large banks, and because one of the topics is kind of explored regularly, and in fact we picked it up in a relatively recent conversation on banking infrastructure. So kind of swapping out core banking platforms for incumbents, critical infrastructure. It's not as simple as kind of picking up the phone, talking to the right person, like, hey, we've got this great deposit or transaction engine or whatever, you should buy it. It's multi-touch point, it's multi-year in many cases. Mm-hmm. What's for kind of the aspirational enterprise fintechs out there, what's the ideal kind of route from initial touch to close with a big institution?
Yeah, unfortunately there is no easy answer. And I think the process really hasn't changed. I think some of the larger players, it takes a long time. You need to build their trust, especially with a product that hasn't actually been used before, in a way that hasn't been sort of shown to show value before. It's completely new, and so the way we went about it is you need buy-in from the top and the bottom. So if you can get in front of the people, the head of consumer lending or head of mortgage, and have those type of discussions, but also at the same time make sure you're talking to the ground level, the loan officers and IT team, to make sure that no one likes to be strong-armed into like technology, but you want them, both the top and the bottom level throughout the organization, to love the product. It's got to be a great product. It's got to make everyone's lives easier. Like the CFO wants to write a check, every month or every year for this technology. Give him a really easy reason to do so, or he or she. Or your head of IT, make her or his problems go away with sort of security and compliance and everything else. If you can solve some of those pain points for people right across the organization, I think it's a lot easier.
Yeah. How much kind of challenge was there early on around, financial stability, long-term viability? Like, how do we trust that you guys are going to execute on this and support us for core function, which you're kind of asking to fill?
It was that was the hardest part. I think at the start when Wells Fargo really went out on a limb and worked partnered with us early on, and I think we sort of started small in sort of regional locations to sort of prove value, and then kind of rolled out from there right across once we started to show more and more value. But this is a problem that almost all startups have, where if you're working with some really large or big important customers and you're handling their critical infrastructure or the main part of business, how are you going to stick around? How do you? And the truth is, the only advice I can give is make sure you have enough capital raised such that you can prove that you're economically viable over time and that your business model is actually pretty sound. Because ultimately, at the other end of the spectrum, there might be a customer, but they also, if they're a true partner, they want to make sure that you're going to be around long enough and that your business model makes sense. So yeah.
I think you guys are rolling out other products also. So mortgage product to date, but there's a deposit product now, right?
Yeah, no. So, the cool thing about, mortgages is it's the data superset of every other loan product. So if you really think about how much data is involved in a mortgage, it's pretty much everything. Your Social Security, your W-2s, your employment history, your taxes. And so every other loan product is kind of a data subset of that. So whether it's a personal loan or an auto loan or a credit card. So we're actually doing account opening is a new product we're rolling out, which kind of gets the consumer a little bit involved in part of our process earlier on. We do HELOCs or home equity lines of credit. And origination and refinance as well. So those are and we have others planned for release.
Yeah. No, it's interesting to think of in the context of kind of this, quote unquote, banking as a platform type shift. So it makes perfect sense kind of coming out 2008 that there were better ways to kind of help banks originate mortgages with greater transparency and digital functionality. But going forward, like if I think about the UK, for instance, market where I have more recent experience, there are tons of existing mortgage lenders. Retail mortgages, buy-to-let is a huge market. It's been a huge market in the UK over recent years. And it's now easier to get a banking license, or at least it's more straightforward to get a banking license in the UK than it was 10 years ago. And a lot of the kind of legacy lenders are thinking about lowering cost of deposits by getting a banking license. So a product like this is like an out-of-the-box way to kind of not only streamline the mortgage piece, but also plug in a deposit offering.
No, that's right. And I think the name of the game, so in the U.S., the colories of that in the U.S., I can tell you most of the lenders are, if you go to any of the big conferences, they're all talking about margins. And it's kind of been, it's a tough time in the mortgage market, just generally. And I think when you start offering technology that lowers costs to make account opening very easy for the would-be lenders or so on, it's a no-brainer. You're lowering the barriers to entry for a lot of these, so it's definitely a plus for everyone.
I wanted to pick up on a partnership that you guys announced. I don't know if it was this year or last year with Lennar.
Yes.
Will you tell us a bit about that?
Sure. Lennar, is the largest home builder in the United States, and I think the home builders in general are a very unique sort of a sliver of the mortgage space or home builders. So most home builders, particularly the big ones, usually have financing arms. And in the U.S., what's interesting is that we have a supply side crisis. So when you click on the news and you read about Silicon Valley or New York, you often read about house prices going up and up, and everyone talks about because there's a lot of demand and there's a lot of jobs, people want to be here. But the truth is actually there is also a supply side problem where they're just not building enough homes. And so what's interesting about the home builders is you've got this unique situation where you can kind of get the complete life cycle of the home. So they build the home, and then you usher people into it, and there's a nice high conversion rate for people from actually looking at the home and finding their home and actually being financed for their mortgage and moving in. And then the process repeats. And so before, it was kind of, we get these people in, we give them a whole bunch of paperwork. That first experience of finding your new home was really beautiful. And then it was kind of a lot of paperwork, and it was very arduous. And then at the end of the day, Lennar, or just home builders in general, couldn't actually see, in a machine-readable way, who was actually buying their homes. It was very anti-transparent. And so using our process, it is a seamless process from start to finish, from finding your home all the way to actually moving in and getting your mortgage. And now they actually have a lot more data from supply side building all the way through to the people who are actually moving in. So
is this, and I don't know, potentially leveraging your technology, is this part of a reconsideration of the kind of mortgage lending value chain? Because I don't know, if you got an out of the box mortgage origination flow, why shouldn't non-bank? You already talked about non-bank lenders using that. In this case, it's the builders themselves using that. I don't know. You could imagine other players who haven't traditionally been kind of originating mortgages directly, leveraging the technology to do that.
Yeah, no, I think that's probably true. I don't know whether it would be mortgage in particular. I think mortgage is a hard place to start, but you could certainly see them focus on or start with other products like account openings or student loans or so on and so forth, and use our product seamlessly for that. Yeah,
I'm interested in kind of the high level question around kind of the role of Silicon Valley in banking and finance. Kind of like what it should be, what the optimal role is, what Silicon Valley's appetite for playing in the space is, both from an investor's and a founder standpoint.
Well, I think I alluded to it, at the start of the conversation, but one of the things that was really surprising to us when we started the company was how little attention Silicon Valley had actually given mortgages, but generally financial services, and fintech was pretty nascent. You have to remember, I guess like 7 years ago, everyone was talking about like Snapchat and Instagram and consumer products or consumer apps, which were really cool. Mortgages probably weren't that cool. So I would say that it's been great that Silicon Valley or the tech scene in general is taking this more seriously and seen a larger opportunity. I think one of the things I've noticed that's changed over the last sort of 7 years is when Silicon Valley actually turned its attention to financial services. In general, it was done in a way that was more combative. So it was always, I'm going to disrupt the banks, I'm going to put them out of business, and so on. And it's sort of SoFi's of the world, they built a great business model and they went on and did that. But it's an extremely hard business model because you essentially have to build out your own sort of distribution and customer loyalty. And I think there's been a marked change where a lot of the technology companies now are actually focused on empowering the banks, actually partnering with them for greater distribution, having a greater impact. Like if your raison d'etre is to make a difference to the consumer or make their lives easier or make it more inexpensive, then the fastest way to do that is actually partner with the bank, because overnight you can have millions of consumers suddenly on your platform. Whereas fighting with banks all the time is I don't know if it's the most impactful way to do.
Yeah, but I mean in terms of like I don't know, the kind of traditional like Uber mindset approach to things and to opportunities and to global reach and to scalability, like it's a massively valuable market, U.S. focused. I mean, if you're starting a fintech company in Silicon Valley, it's U.S. focused. Like it's very rare, I think, that you're, I don't know, Stripe's like a great exception of kind of a global product. But otherwise, it's pretty much U.S. focused. They're the regulatory complications, state by state, things change. So, I mean, how does the kind of traditional like Silicon Valley mindset mesh with those constraints?
I think sort of the regulation, well, certainly the environment post 2008 has changed a lot. Regulation is more commonplace, and I think it's more on the side of the consumer. And if you're building a consumer first product, I actually think you can see it as a tailwind, not a headwind. So, for example, our product, mortgages are heavily regulated. You can't just do whatever you want and produce the sort of workflow and however you see fit. There are certain standards you need to meet, And I think if you we work closely with the CFPB and we work with all the regulators that we need to do. But the cool part is if you actually show them what you're doing, you show them, instead of like consumers filling in faxes and, losing social security numbers, it's actually going to be on a secure database. It's all going to be machine readable. It's all going to be transparent, and everything you do is going to have a digital audit trail. I mean, they will fall out of their chairs. I mean, they think what we're doing is great. So I think if you approach it in a sense that you can't fight regulators. I would not suggest fighting regulators and go, like Ubers of the world. They went in. Not to call them out in particular, but they went in and they kind of just built it, and eventually the regulators in certain, like London, for example, kind of catch up, and then they have to fight these big legal battles, and it's a long process. Another example would be, the crypto space or blockchain in general. There's no real clear representation about what blockchain really sort of is or how it should be treated. Is it like, if you're a crypto fund or a startup, do you classify it as equity? Is it a security? I mean, is it a commodity? And the truth is if you work with the regulators, I think you're going to make a lot more headwind because it's just, it eventually catches up and you're going to have to work with them anyway. Yeah. So my advice, always try and turn some of the compliance and the regulation piece into something that's actually helpful.
I think you guys raised money from Greylock recently?
We did.
Recently?
They led our Series D in the summer of 2017.
Okay. What's the relationship with them been like?
It's been great, actually. I cannot recommend. Jerry Chen is the partner there, and I can't recommend him and the firm enough, actually. They're being great to work with. They are very hands-on. Mm-hmm. If you want them to be, I mean, we have, and so they help with recruiting and sourcing executives and key talent. They're a top tier firm. I couldn't recommend them enough.
What should people expect from Blend going forward?
I think the ambition has always been to be a multi-billion-dollar company. I think what I would love to say that we are in sort of 5 years from now is there is this big push, not just for Blend, but in the fintech space in general, in banking, is eventually you're going to end up with these financial profiles as you go through. I mean, each consumer. So if you go through, you apply for a mortgage, you apply for account opening, whatever it is, you're entering all this information, and it gets frustrating after a while, I'm sure. And the banks don't want you to be frustrated, and you don't want to be frustrated, and you want to make it as seamless but secure as possible. So I think what it would be great for Blend to be known as is this platform that offers all these products that allows the banks to actually, and the consumers to kind of have their profile, and you can move quickly through whatever loan product you want and get where you need to be. Does that mean
across banks also?
I don't know across banks. The consumer is the consumer of the bank, and that's kind of a sacred thing, I think. But what we can do is help the bank better serve the customer, and then allow on the other side of that, allow the customer to actually get access to capital. So, for example, if you're we have a lot of data coming through our platform, and if you apply for a mortgage if you're in a low income family, you're 3 times more likely to apply for a mortgage on your mobile phone. Is what we've discovered. So, because lower income families don't typically have laptops or big fancy desktops, but they have their phone. And so, on the consumer side, it'd be great to be also known as a platform that provides access to capital. So it's not just about ease of use and actually having sort of a way to analyze the data that's coming through and provide these products, but also provide access to people that would not have got it otherwise.
Yeah. Excellent. Well, best of luck to you.
Thank you. We will keep working.
Erin Collard, thank you very much for joining us today.
Pleasure. Thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.